Hey everybody, welcome back to another beautiful day in real estate. So we have been talking all about the war, all about economics, private credit issues, all that for the last few weeks. So we're going to jump back into real estate this time. We're going to talk a little bit about North Dakota. So first, before we jump into that, let's talk a little bit about mortgage rates. We'll talk a little bit about the 10-year and the oil pricing, and we'll bring ourselves back to a conversation. So this is not really a video about news. This is going to be more of a video about my opinion of the market, what to expect this year, and just, optimism really is still in my screen. So I should say in my brain. But anyway, interest rates, you guys, relatively unmoved the last few days. Until that ceasefire becomes, we see some news past it, I just don't expect things to move very much. I'll be honest, after the negotiation failed on Friday, which was pretty unhopeful to begin with, I don't think that we're going to see a lot of positive news moving into this next week. I think a majority of people are waiting, right? Everybody's kind of waiting. The market's at a standstill right now. We're not seeing interest rates move. 10-year bonds aren't moving that much. Oil's kind of in that consolidation. And speaking of, let's talk oil. Let's talk 10-year bond. So we've been talking and following the 10-year bond here along with oil since the beginning of the war. As you can tell, right here is about when that war started, March 2nd. And we saw a pretty significant move in the upright direction, which was not great. Let's see, where did we see? Total of about 14% in falling or in increase on the 10-year bond. When you see stuff like this, it's 55 basis points. That means that we are seeing higher interest rates, right? We were under the sixes on conventional for a short time, and then the war broke out. And then after the war broke out, now we have depending on which side of the seat you sit on, but we're starting to see momentum into the higher 10-year Treasury bonds. That's good for big time investors. It's bad for people who want to buy homes. I wouldn't even say bad. It's just not great, right? I mean, interest rates really haven't moved significantly high. I mean, we're still sitting again at that 6.4. So we're about 220 basis points or basically 2% above that 10-year bond. And 30-year mortgages, for those of you that don't know, follow the 10-year bond, right? So when this moves up, interest rates move up. When it moves down, interest rates move down. We saw some pretty positive movement for a while there from our high at 4.8, we were sitting at like 7.25 interest rates at that point, which was back here in 25. And then we've kind of seen a trickle down ever since. We broke through the resistance on the downward trend. We had 1 point of contact, 3 points of contact, and then it took off. We also saw that kind of bounce. So to me, it makes sense that we're going to consolidate here, at least for now, until we see what happens in the war. We have to kind of figure out what this ceasefire means. As you kind of see, when the ceasefire happened, everything went down, broke below, looked like we could almost touch off the 4.9, 4.2, or 4.19, 4.2 range, and then it bounced right back up because the ceasefire wasn't technically a ceasefire. And then the United States comes in and starts blocking the Strait of Hormuz, and then that pushed bond pricings back down again. Again, until we see some more certainty there, I just don't expect much movement, nor do I expect really anything to happen in a positive manner, not necessarily a negative manner, right? So if we're talking oil, right, yesterday they came out with that. What is this? This is Monday. So Monday we saw a spike of a gap, and like we talked about yesterday, those gaps have to be covered. They always are, right? And it obviously recovered right away, and now we're back at the 95 number, which right before open, actually opened 3 minutes ago, the market, and it's just heading down. I still think this consolidation range of 101 to 92 is really plausible. Again, until we see some more movement on the negotiation side of things, right? Everything is in a standstill right now, and most people don't realize how much that war is truly affecting the entire market right now. Now, North Dakota, we're going to shift. We're going to shift to North Dakota, right? Because North Dakota is where I live. That's where all my business is. I don't know why I said most, but all my business here is in North Dakota, right? So I know North Dakota's market very, very well. Right now we at our 1.8 months of inventory. We are significantly low on inventory. I have people that are looking to buy, and it's crazy. In their criteria, literally their criteria says no twin homes, and they want to be in a certain elementary school district. There are 3 homes available that are within the price range that they want to be. Either you're 600 or under, or you are above 800 in this market, and they need to be under 600. There's literally 3 options right now. That's how minimal the inventory is. And North Dakota naturally is a lot more resistant than most economies in the United States, because we have the natural resources, which keeps us structured very well. Whether you're talking oil, you're talking gas, or you're talking about the coal industry, we have significant strength against most major economic turns. It's partially why I love North Dakota so much. I was looking to move to Minnesota. I was looking to move to Florida a few years ago with my wife, and we decided to stay in North Dakota. Not because Florida is not an amazing place, but because North Dakota has better opportunity, in my opinion. In the last few years, we've really proven that. We've really taken ourselves from a young young realtor in the space to somebody who's now working in new construction, working in developments, working in residential, and starting to really advance more investors into the space. But what I know about North Dakota is that it's a good place to live. People here think things are getting more expensive, but if we compare it to around the United States, the numbers here just make more sense to be in North Dakota. It's a safe environment. We have good schools. The schools are not dangerous. They're not, there's no, and I don't know what all big markets are like, but I know a lot of them, they do have metal detectors and there's hundreds of kids at each school, et cetera. I mean, we're still relatively a small community. I mean, I think there's 70,000 people between Bismarck and Mandan, which really isn't that many people, right? If you think about it. Rush hour is getting a little busier, right? It takes 20 minutes to get somewhere, across town rather than 10. So it's getting a little busier. But what we're not seeing is a huge negative effect in the real estate market. If anything, right now we're seeing a very positive. North Dakota saw a 6.6% increase, and Bismarck on average for a year-to-date increase in valuation in their home. Some homes, the market's been kind of neutral, I'll say. But people who bought into their homes last year, especially building, on average, are seeing a return already on their home, or at least an increase in value. And I've noticed that a lot of people are very scared to get into homes right now. Either they're gung-ho and they're just going after it, or they're the most finicky people in the world. There's really no in between. I'm working with a couple buyers right now that are just scared to jump on homes because they feel something else might pop up, or they feel like they're minimal inventory. I'm encouraging a lot of people to build right now, though, because building just makes sense. Not only because I'm in new construction, but I mean, it makes sense. If the inventory is super short, but you're gonna pay for a home that you really want, why don't you pay slightly more upfront for a home that's gonna be exactly what you want? You're gonna get a lower home insurance rate, which is typically cut in half from the secondary market. You're gonna get an incentive from the builder, and you're gonna pick the side of town you want to be on. So I'm strongly considering, or pushing my clients into building, whether it's with me as a builder or somebody else. I don't really, to me, that's irrelevant. I'm always going to present my builder first, right? Because that makes sense, right? For business purposes. But if I don't make sense for me to build them a home, then I'll encourage them to check out other builders, because here's the thing. I know what I can build, but I also know that I don't fit everybody's criteria, and I'm not going to deteriorate somebody from the home they really want to be in because I'm deteriorate, I guess, from the opportunity, because I just want them to be, um, I guess, want them to be under my building roof, right? But the thing is most people are starting to realize that building makes more sense. I'm sitting there with a couple today here in about 2 hours, and they're building too. They've been living on the golf course in Bismarck for a long time, and their husband's a big golfer. The wife really wants to be in a better area for, no steps we talked about. And the equity that most of these guys carry is a big, significant thing. Now, when it comes to home equity, the problem that I'm starting to see with a lot of the younger generation, I guess, and I'm still part of that younger generation, right? But I guess I'm almost 30. I think they're moving quick. But the problem most people think is that they feel like there's going to be a real estate crash. Now, I can't speak for the rest of the country, but I do know in North Dakota, I'm going to be very, 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 very surprised if we see a real estate crash in Bismarck, North Dakota. The reason that is because most people don't really understand it, but right now the inventory is so short. There's still so many buyers out there. If a home is in good shape and it's priced correctly, it's selling immediately, right? And people are trying to compare this to the 2008 crash. And again, I'm going to be adamant that this is not a 2008. Again, it's a 2026, which means that real estate won't be the driving factor that crashes the market. It's going to be the private equities market. And coincidentally, the private equities market was created after 2008. And after 2008 is when we started to leverage private credit. And the thing that really frustrates me the most is I never saw this until recently. But the people that are at risk the most are the 401k, pension, and the average middle class. The banks aren't holding the bag anymore. They're transitioning and transferring, value across asset paths and across asset barriers, but you are the one holding the bags. So when I encourage people to get into real estate, it's because I genuinely think that's going to be the one thing that's not going to get disemboweled by this private credit market, which is over $2 trillion. And in some numbers, I'm seeing 3 and 4 trillion. I don't know where they're pulling these numbers from directly, but people don't people don't feel confident. The lowest consumer sentiment we've seen in 20 or 30 years, the highest on affordability for homes that we've seen. And yet people are still buying homes, which that unaffordability thing again comes down to who you're working with. I get it. Maybe we can't buy the $450,000 house that we want. Maybe we have to start in a $250,000 house. Like, there is opportunity to get into homes, but I think expectations for some people are still in that COVID that low interest rate environment, and it's scaring people away from the market because they can no longer buy a $600,000 house for a $2,000 a month payment. Now you can buy a $350,000 house for a $2,000 a month payment, right? Those numbers are not correct, but you get what I'm getting at, right? People are now having to pay more for homes, which is turning them off from the opportunity to buy homes. A lot of people, I should say, but there's still quite a few people out here who want to actually buy a home. They want to live in a home and they want to start building equity. I'm working with somebody now, 100% an investor. Looking at the numbers is all that he's focused on, because when he's looking at the numbers, it makes sense to him, right? A lot of people are looking at the numbers and they're not even attempting to get into a home because they feel like there's no opportunity there. Now, I'm here to tell you that the opportunity is there. And if you want to get into a home, all you have to do is make a phone call to me, to somebody you trust, a lender, and a good lender and a good realtor is going to guide you through the process of creating a way to get you into a home. Now, I'm kind of all over the board, but I really want to encourage people to get into real estate. Real estate is a very, very good industry, whether you're an investor, whether you're, just trying to build equity. Right now, I feel that it's more valuable as a real estate agent to be guiding families into homes rather than investors, because investors, high interest rates means that there's going to be a lower probability of cash flow. But for homeowners, you're buying a house at a discount, because right now homes are lower than the valuations will go up when interest rates go down. All right. We didn't see a significant pullback in pricing, so everybody thinks that homes are overpriced, but I think homes are priced where they should be right now. And I think that once interest rates come down, which they will over the next 2 years, I know all of the factors that we're looking at. We're talking about war, we're talking about inflation, we're talking about unemployment rates, we're talking about a new Fed chair. We're seeing all of these topics in the news. But what I do know is cycles, and cycles say that we're going to see an up and we're going to see a down period. And right now we're in a down period. So as we start to see that down period start to go up, we have to see interest rates go down to continue to bring liquidity into our system, et cetera, et cetera. So people think that because you're buying a home at a high interest rate, now you're getting effed, you're getting screwed. I'm here to tell you you're not, especially if you're a residential buyer, especially if you're getting out of renting. Like, dude, right now people are paying $2,200 to $2,800 a month to rent on an average for a twin home. Just a twin home. That's not even owning, but we could buy that same twin home with the same monthly payment, and we could gain equity from it. That's what concerns me, is that so many of us believe that homeownership isn't possible, that we're willing to throw away thousands of dollars a month that you'll never get back, on top of the fact that you're going to put a 1 month deposit down on a home, right? On a twin home or whatever, and you're never going to see that deposit again. And somebody told me, well, why don't sell it, or why don't landlords give it back? I'm like, if you're there longer than 6 months, there's good opportunity. There's more than $2,000 worth of shit that needs to be fixed in that house. So I'm always going to encourage people that you need to get into a home. You need to start building equity, and you need to start getting some wealth from that aspect. Hard assets are the ones that matter the most. If you're buying land, I had some young kid came in, he bought his first lot. He bought it and he goes, I'm not going to build on it for a while. I just wanted to start owning land. And he bought his first lot. I mean, like, that's the good stuff to be in right now, because everything's so uncertain right now, and the valuations of product continue to go up. Inflation continues to join. We have high energy prices. That's 21% higher for oil and gas than it was a month ago. We saw the increase in inflation from 2.7% to 3.33%. Now, again, when it comes to the interest or it comes to inflation, if you're not making over 3.3% on your interest, you're losing to inflation. Your money's worth less than it was last year by 3%, right? So, all that being said, when you're buying into a home, people think, oh, I have to pay more than rent, right? You're paying a little bit more, but you're also putting money back in your pocket because even if you're only paying down 30% of your principal, your payment is 30% principal over the course of the first few years, you're still putting 30% of your payment towards equity growth, right? And on top of that, you're seeing on average 3 to 5% increase in Bismarck, North Dakota. So you're seeing about 3 to 5% increase on the home every year, which again, inflation is sitting at 3.3. Now you're beating inflation. Now you're building equity because you're paying it down. So you're building some sort of wealth and you're doing it for living. And a lot of people don't want that conversation anymore because for whatever reason, we're brainwashed to think that an overvaluated stock market is going to make us all millionaires. It's not. The thing that I had to realize, it took me a long time, is that being an investor is not glorious. It's not exciting. Being an investor is not the Wolf of Wall Street. Being an investor is not Boiler Room. Being an investor is not these, the Big Short where you're going to get this humongous gain because you think you know what's going on. It's about being slow and meticulous and evaluating every step of your investment journey, right? But most of us think that you just have to come in and start making offers and all that. I mean, I know a buddy of mine, he's been getting into real estate. He's bought 3 or 4 properties in the last year because everybody else is scared to. People want to sell their homes right now, especially their multifamilies, because they want to make some money on them. There's uncertainty. We don't know what to expect, but he's doing phenomenally well because of that. My whole point of this video was to talk to you guys about getting into real estate because, again, being in real estate is a valuable piece that is going to guide a lot of you younger people into start building wealth. And a lot of younger people are scared to get into real estate because their parents telling them, well, I wouldn't buy right now, the market's going to crash, or they see headlines about how interest rates are high and unaffordability is the biggest problem. And I get it, man. There's in some cases, in some markets, it is damn hard to get you into a home. But if you have the opportunity right now to get into a home, I don't care what market you're in, I encourage you to do so because in 5 years from now, 10 years from now, I am going to be very, very, very shocked if you are not exactly excited about what you bought. Granted, make sure you're buying a house that's worth buying, but we have opportunity to build wealth, whether we choose to accept it or not. It might be a little bit harder than it was 20 years ago, but we still have an opportunity to do so. So my encouragement for you today is, as I end this video, is if you don't know what's going on and you feel like you're not getting where you wanted to, or you not getting the information you need for real estate, reach out to me directly. We can either meet one-on-one or we can do a video if you have a topic you want me to go over, and I'll dive into it. I want everybody to understand that owning real estate is one of the best things you can do. And until we can get more of an audience, we're going to continue to push out videos like this so that you guys can see a little bit more of me, a little bit more about what my mission and goals are. So until then, I hope you have a great day. We'll see you soon.